Welcome to this edition of IBFD's Tax Takes News and Views, bringing you the week's tax news in a nutshell. I'm Stuart Gibson, IBFD's Chief Editor, Global News in Washington, D.C. With me for our Beyond the News interview is Barry Larking, Special Counsel at IBFD in Amsterdam. On today's show, hope springs eternal for the OECD as the U.S. announces a major policy shift. Portugal imposes carbon taxes on travelers. And does the new UK budget signal the end of the race to the bottom? These and more, including Barry Larking's interview with Alison Christians, the Stikeman Chair in Tax Law at McGill University in Montreal, coming up on IBFD's Tax Takes. First, we turn to the top news of the past week, as reported in IBFD's Tax News Service. When the Biden administration took office in January, the clock was already ticking on the OECD's July 2021 deadline to reach consensus on measures to address the tax challenges arising from digitalization of the economy. Many obstacles stood in the way. From a practical standpoint, there was the need to appoint a Treasury Secretary and a team of international tax experts. As for policy, the U.S. had to remove the albatross that former Treasury Secretary Steve Mnuchin had hung around the neck of the incoming administration, the demand that any system that reallocated taxing rights under Pillar 1 include a safe harbor, allowing individual companies to opt out of the new system. Thus far, President Biden has met these challenges. He appointed Janet Yellen as Treasury Secretary, and she quickly installed a veteran team of international tax experts to engage with the OECD. And last week, Secretary Yellen tossed the Mnuchin albatross overboard when she announced that the U.S. has abandoned its demand for a safe harbor. This has now energized the OECD. During a webinar last week, Pascal Saint-Amand noted that the stars are aligned for the 139 members of the BEPS Inclusive Framework to reach consensus on time, and expressed optimism about announcing a final agreement at the G20 Finance Ministers meeting on July 9. That said, a little luck couldn't hurt. It's one thing to sign a document agreeing to reduce greenhouse gas emissions. It's another thing altogether to take action. Portugal is the latest country to tackle greenhouse gas emissions by placing a tax on carbon. Starting on July 1st, air travelers departing from Portugal will have to pay a carbon tax of €2 apiece, and travelers arriving in Portugal on passenger ships powered by fossil fuels will have to pay the same amount, €2. There are a few exceptions, such as for emergency situations and infants under age 2, but starting this summer, if you want to travel to or from Portugal, you will have to pay at least a portion of your carbon footprint for the privilege. When Ireland lowered its corporate tax rate to 12.5%, and the UK tried to follow by cutting its rate to 19%, commentators decried these and similar moves by other countries as a race to the bottom. If the UK budget announced last week by Chancellor of the Exchequer Rishi Sunak is any indication, either the race is over or the UK has stopped running. If there's a theme to the UK budget, it may just be all about raising cash. In fact, the budget could be set to the OJ's funk hit For the Love of Money that includes the lyrics, "Money, money, money, money." One way the budget raises cash is by hiking the corporate income tax rate from 19%, below the OECD average, to 25%, above the average, and the diverted profits tax, remember that one, from 25% to 31%. The budget also takes a bite out of individuals, freezing tax brackets and allowance levels for 4 years, and in what might be an effort to cool the red-hot real estate market in London, the budget imposes a 2% surcharge on land stamp duties for non-resident home buyers. Budgeters have tried to soften the blow on businesses by keeping the lower corporate income tax rate for small companies, delaying the rate increases for 2 years, establishing a system of 8 so-called free ports, and introducing what they call a 130% super deduction for qualifying expenditures on plant and equipment for the next 2 years. But make no mistake, the net effect of these changes will have British businesses and subjects, and some foreigners, paying more into Her Majesty's Treasury for the foreseeable future. And now moving on to other news. The European Union has been lurching toward greater tax transparency for a few years now. Its directive, known as the DAC, already requires companies to report a host of cross-border tax arrangements. The Portuguese presidency of the European Council has pushed to require public country-by-country reporting, and last week the Portuguese presidency was directed to enter into negotiations to amend another directive that could eventually require large multinationals to publicly disclose, among other things, how much tax they paid to each member state. The Supreme Court of India handed foreign software providers a victory last week. It ruled that when Indian residents buy software from foreign sellers, they are not paying royalties. Thus, the court ruled the payments are not considered taxable income in India and are not subject to withholding taxes. And finally, last fall, the ride-sharing service Uber scored a big win when it defeated a ballot referendum in California that would have classified its drivers as employees entitled to receive benefits under state law. The company had little time to celebrate its California victory, however, before losing the same issue in court halfway around the world. Last week, the UK Supreme Court ruled that under UK employment law, Uber drivers must be classified as employees entitled to earn the national minimum wage and annual paid leave. As the company is likely to pass these costs on to its riders in higher fares, what is bad news for Uber could be good news for beleaguered British cabbies. And now we go beyond the news for Barry Larking's interview with Alison Christians. Barry.
Thank you, Stuart, for your informative news report. I'm Barry Larking, Special Counsel at IBFD, and I'm delighted to have with me today Professor Alison Christians, who's the Stikeman Chair in Tax Law at McGill University in Montreal, Canada, where she writes and teaches in the area of national and international tax law and policy. And she was recently named to the International Tax Review Global Tax 50, in particular for her work in the digital tax space. So we're really happy she's here today to talk about her idea of a third global tax pillar. Welcome, Professor Christians.
Wonderful to be here with you.
But before we dive into that, I know you've just kicked off an online initiative called Break Into Tax. Can you share with us what that's all about?
Yeah, just a series of interviews aimed mostly at students who are thinking about or are currently breaking into tax. So we invite everyone to join us and watch our videos. You can find us on YouTube.
Great. Okay, so check out Break Into Tax next time you're on YouTube. And now let's move on to the subject of today. Thanks for that explanation. There's increasing talk of a need to tax digital giants that have profited from the pandemic. What, in your view, is driving this? And shouldn't we really be rewarding them rather than taxing them? It seems somewhat counterintuitive.
It's a great question. I don't think it's about reward or punishment, actually, when we start thinking about excess profits. But I do think that what we start with when we get the pandemic kind of in our scope is that we're already in a world in which giant multinationals seem to be escaping tax everywhere. They just seem to be not paying very much tax anywhere. And why is that? And of course, we all sort of understand why that is. The business model is changing to sort of scale without mass. But as the pandemic hits, these companies, the highly digitalized companies, the high-tech firms seem to be making even more, even massive amounts of profits, and not always due to their innovation or their creativity or their hard work, but instead due to some sort of market problem. And so that's, I think, why we say the digital tax space kind of opening up.
Yeah, and so you don't consider that this would in any way sort of disincentivize them to improving their product or services?
Right. The idea of an excess profits tax is that what you're getting at is that tranche of income which is in fact not related to the skill or creativity or innovation of the person that's reaping the profits, but it's due to some sort of market anomaly. And so taxing in a way doesn't actually impact behavior. This is the economic theory.
Okay. Right. Well, that's clear. Now, I think it was around a year ago you floated the idea of this global excess profits tax, or third pillar as it's become to be known. How would it actually work in practice?
Yeah, the idea of the third pillar that I worked with Tarcisio de Magalhães with is that, you already have the OECD building data sources and building ideas, theoretical concepts that are amenable to some expansion of taxation basis. Okay, so you already have that in the works with Pillar 1 and Pillar 2 in the digital space. So anybody that is sort of aware of the OECD's work on BEPS and BEPS 2.0 knows about this Pillar 1, Pillar 2. But basically what you have there is Pillar 1 saying that there's a different kind of way that we might think about allocating profits. And one of those ways is with a kind of an ideal of a fixed return to certain kinds of activities. And the Pillar 2 is about a minimum tax. And so when you combine those two with the OECD's information gathering and sharing resource, which is country by country reporting, you now have this sort of mechanism to think globally about excess profits. That is, you can look at firms and say, okay, what has changed? Where are these excess profits? And then if you start to dig into the details, you'll see that the OECD has done some work on, with this Pillar 1, has done some work trying to figure out, well, what are routine profits? What do we expect? And then what are these extra profits? And then looking at those extra profits, can we divide them in a different way than we have in the past? And the excess profits tax just says, okay, if you're already doing that, then you're already on a line of thinking about routine and residual that is very similar to this idea of normal and excess or abnormal profits.
Okay, so the idea would be to build on the Pillar 1 and Pillar 2, and once you've identified these excess profits, is the idea that you would simply slap an additional tax on top of that? Right. Yeah. Okay. That's nice and clear. Now, I want to come back to something that you said that you've been quoted as saying in the past. I know it's sometimes uncomfortable to be confronted with what you've said in the past, but let me tell you what it is. It's that the line between routine and residual is virtually impossible to ascertain with economic certainty. Now, I think you said that in the context of Pillar 1 or Pillar 1. Don't you face the same problem, therefore, with your excess profits tax? And isn't that asking for trouble?
Yeah, exactly. I mean, I'm glad you used that quote because that is exactly correct. That is the thing that the OECD is trying to do with Pillar 1 is economically not quite precise. It's not a possibility. It's not actually possible to draw this line with precision. And so what they're doing is using proxies. And what you'll see, for example, there was a KPMG study that showed, the average profits being, normal profits being about 22% of US-based multinationals, and that the KPMG study looked into the details and said, well, 8% looks like routine and about 14% looks like residual. So of course you can't draw it precisely. And, even within that KPMG data, you have industry differential, geographic differentials to take account of, right? And so what the OECD is saying is, okay, but can we find some sort of proxy or some sort of compromise around which we're basically comfortable? And then from there, can we divide some of that up? So once you've already decided that that's an okay thing to do, that is, we're doing some compromising, we're doing some consensus decision making, which we know are not based on economics, but are based on what's politically and technically feasible. Well, now you're just repeating what we did 100 years ago. Well, I mean, you could have that exact same conversation about the idea of source. What's the source of an income? Well, we're just going to come up with a compromise solution on that. What's residence? Well, we're going to come up with some compromise solutions on that idea. So the excess, the residual, the routine, all of these things are ideas. They're conceptual ideas. They're not some, thing in nature that we can just go pick out and find and put, now we're happy we did it the right way and so everybody should accept it. That's just not the world we live in.
Yeah, no, I think that's very clear and very apt comparison with indeed the source residence debate. But notwithstanding those proxies that are aimed at simplifying what is otherwise a very difficult, perhaps impossible task, isn't your proposal of a third pillar, the excess profits tax, complicating an otherwise already overcomplicated situations? We're already trying to construct two other pillars. We've got individual countries who are not just considering or applying digital services taxes, but also considered, like the Netherlands is considering slapping an additional tax on the digital giants, should we say, those that have profited from the pandemic. And then you've got the EU, who's also considering its own digital levy, which is a separate issue from Pillar 1 and Pillar 2. I mean, it may be a good idea, but as I say, isn't it overcomplicating things?
Sort of piling on, yeah. Okay, so this is what I would say about it. I would say that there's a certain level of complexity that has crept into international tax, no doubt, already in the sort of standard income tax system. Arm's length transfer pricing is a great example of that. So you already have a huge amount of complexity there. So there's a need to not build more complexity into the system. But what I see in the digital service taxes area is that a number of states are saying, yeah, notwithstanding the additional complexity, notwithstanding the additional administration, we actually do need to get revenues, and we're not getting them the way we have. And so I think Pillar 3 is a very clean way to do that, because we're not building anything new, nothing new. The only thing we're changing here is the rate, which is a very simple thing to do based on something the OECD is already doing. So if you have a problem with the OECD Pillar 1 complexity, I'm with you. I have the same problem that you have. But if they get there, then what we're saying with the GEP tax is, if they get there, then actually it's a very small move, a very minor move, and not a technically difficult move, to look at those residual profits and say, actually, there is something structurally different about those kind of profits, and it is okay, it is safe economically to tax those at a higher rate.
Right. The last word, rate. Under the Pillar 1 proposals, there would not be one rate. It would be up to individual countries to apply their standard rates to the profits that get allocated. Is your idea the same, that each individual country would be able to decide its own GEP, global excess profits tax rate, or should there be a single tax rate, a bit like your Pillar 1 minimum tax rate?
Yeah, so there we go with this Pillar 1, Pillar 2 connection, right? So it's already kind of difficult even before you start thinking about an excess profits tax, because you have to understand how Pillar 1 and Pillar 2 might work together. They seem to be unrelated, but they're not really unrelated, because Pillar 2 is saying, to the extent country A doesn't tax, country B can step in and tax that income stream as a secondary matter. So the excess profits tax rate is that exact, it just follows that exactly, right? If country A gets its amount A and taxes it, then there's really just nothing you're going to say about that. But if they don't, then you could step into that breach as country B in that scenario, in that Pillar 2 scenario. But to sort of simplify this, I know this is in the weeds a bit. So I'll just simplify this a little bit by saying, right now, the way the OECD is structuring things, it is very clear what they're doing is slicing up the base and trying to preserve the rights of countries to decide what the rate ought to be. And what we're saying with the global excess profits tax is, we're arguing that notice that when you consider that rate, the residual profits are not going to run away if you impose a higher tax. They're not subject to the same economic competitive pressures that routine profits are. And so then if you're a country deciding what your rate ought to be, you can review that routine residual distinction that the OECD has made and understand that what you're being given is residual profits to tax. They might attract a higher tax rate without having any impact on competition.
Yeah, understood. My gut feeling says then, well, what's to stop 100% tax rate? Because that is not going to discourage anything. I think that's probably the point on which we should leave the discussion, given the time constraints. But I would thank you for sharing your views, Professor Alison Christians, who's been our guest today, tax law professor at McGill University in Montreal.
Thanks. It was great to be with you.
Fascinating times ahead, I think. So, and that wraps up this week's edition of Tax Takes News and Views, the week's tax news in a nutshell from Stuart Gibson and myself. Thank you for watching, and here's hoping your week is not too taxing.